Welcome to TheoTrade. This is Don Kaufman. It is June 27, 2018. You are watching the Theo Night video. Seconds, literally seconds to go to the closing bell. Once again, people, we are under a bit of duress inside of the S&Ps. But just to put it in a little bit of perspective as we come to the bell, we're still only seeing about a 1% move inside of the S&P futures. There is the closing bell, literally a 1% move inside of the S&P futures at that closing bell, and some fairly wild trade into the close. Now, there's a couple of really specific levels that we're going to discuss. There's a few trading ideas we're going to discuss. We're actually going to look at a number of ETFs to kind of describe a bit of breakdown in the broader markets. And we want to look specifically at the SPX. So a lot to be covered here in a very, very short amount of time. Stay tuned into this entire video. First and foremost, again, we'll start with the S&Ps, which saw just about a 1% decline on the trading session. One thing that's a little bit peculiar, though, is the fact that, even though the market's under duress, it still is only doing about 2 million contracts. Now, this is something I look at quite extensively. For those of you, if you're like, 2 million contracts, maybe you don't necessarily have kind of a baseline to go off of. And I'll kind of zoom into this. Now, granted, we are starting to approach a bit more of a holiday week, but 2 million contracts, people, that's just not getting it done. It's not extreme. It's not the market, screaming out in pain. And it's one of the tells that we'll have tendency to use. And again, just to use this as a bit of a baseline, so right over here happens to be about 2 million S&P contracts. And one of the questions that that really kind of looms in here is, so why do I bother looking at volume of the S&P futures? It's because this is the entire professional trading arena right here. Okay, and the S&Ps, this is what they use to mitigate risk. You want to see volume cresting at least 2.5 million contracts. You want to see us, if you think there's any degree of capitulation, you got to be flying high. You got to have the S&P volume absolutely explode to the upside. And again, frankly, yeah, maybe it is a little bit of the coming into the holiday 4th of July weekend, but that volume and that pressure is it's just not there for me. Now, we're going to come back to the S&P futures in just a minute. Next, I actually want to bring up the Russell. The Russell, which has been the outperformer lately. And if you will remember, just a few weeks ago, I talked about a big-time trade. It was short Russell, long S&Ps, and it is paying off in a big, big way right now. Again, look at it on a percentage basis, and that's something that I often discuss, is look at everything on a percentage basis. Look at the S&Ps, which are down, again, 0.9% versus the Russell futures that are off a full percent beyond where the S&Ps happen to be. And as you guys will note, I actually shied away from the Nasdaq a little bit, because the Nasdaq lately has been Mr. Toad's wild ride. Nevertheless, we shorted the Nasdaq last week, but we already covered that particular position. And we have a number of other positions on that we'll discuss here momentarily. All right, so I wanted to show the Russell versus the S&P, as the Russell is really under duress. The small caps are taking big, big heat. There's also Russell rebalancing that obviously plays into a degree of this equation. Okay, let's move onward and upward. As I said, I will come back into the S&P futures for specific levels as we go on. Right on down the list, I want to bring up the volatility futures, because the volatility futures, they're incredibly important anytime we start to get into a degree or a bout, if you will, of volatility. In fact, there's several volatility products that we're going to look at here momentarily, but allow me to start and really highlight a bit about what's going on and what you should be looking for in terms of these volatility futures. In the volatility futures, we have 21-day volatility futures. Then you go out a little bit further. I exclude all these weeklies, because the weeklies, they just don't trade any volume. So I look at the 21-day volatility futures, then we go all the way out here to the August volatility futures and even the September volatility futures. And what I want to show you here is specifically, you'll see the 21-day vol futures are sitting at about 1690. Okay, and again, that's about 21 days out. Then we're going to go a little bit of a further duration, out. Out in time, what do we see out in time? Well, that's about 56 days. The circle stands for days. Where's that little monkey trading? Right here, let's call it about 1675. So 1675, then we go out a little bit further in duration, and a little bit further in duration just picks right back up to where? At about 1695, right in this neighborhood here, about 1695. And now we're all the way out, what? Okay, 84 days of duration. Now, this is a very, very interesting volatility skew over here, because what it's actually saying and what you should be able to anticipate from this is that the next 21 days hold as much risk, if not more risk, than even 84 days from now. And 21 days holds more risk, okay, than ultimately 56 days out, okay? So right now, the risk is here. The risk is prevalent, and you have to read into this. Why? Because anytime these volatility futures are inverted, that is going to make the S&P futures that much more schizophrenic. And I cannot stress this enough. As long as these volatility futures are inverted, anytime we pop to the upside, I'm typically shorting into it. That doesn't necessarily mean, okay, that I'm outright short. I'm using defined risk strategies. But anytime these volatility futures are inverted like this, and they are, okay, that's time, okay, for me to step into and try to short into many of the rallies, barring any unforeseen circumstances. A little bit of a kind of confluence with that. And I often look for confluence. I don't look at any one indication of the marketplace and start screaming, it's there, okay? But again, in confluence with this, we actually have the VVIX. And again, I'll just circle this up here. It's the VVIX. What does it stand for? Happens to be the volatility of the volatility index. When you see the VVIX lit to the upside, and I've actually been pointing out the rally in the VVIX even 2 weeks ago, but when you see the VVIX lit to the upside like this, specifically the level north of 110, anything north of 110, that's usually when I say duck and cover, get under your desk and start rocking back and forth, because things are going to get nutty, and they are. So it's just confirming effectively what we're seeing out there. And what the VVIX entails is that traders are coming in and they're buying VIX options like they're going out of style. Okay, now buying VIX options does not per se drive the VIX higher. Okay, it doesn't drive the VIX higher. When they're buying VIX options, though, what it's actually saying is they're afraid. They're afraid of the VIX, spiking up, or again, it's hedging activity. And if you look at the VIX itself and you look under option statistics, the VIX, it didn't even trade that many options today. As I was saying, there was this feeling of like the S&Ps kind of sinking today, and I'll come back to the S&Ps for a second. So there's this feeling of the S&Ps kind of sinking today, but there just wasn't this wild, intense sell-side activity. There wasn't anywhere near that kind of capitulation kind of feeling. Once again, I'll come back to the S&Ps here in just a moment. Now, right on down the list, strength inside of the dollar, strength in the dollar. The irony of the strength in the dollar, which is, unprecedented in a couple of recent trading sessions. The strength in the dollar, that's not impeding upon, oil in any way, shape, or form. Oil took off to the upside today by the tune of, at one point, it was actually up about 3%. But again, oil is just not impeded by the strength inside of the dollar. So there's a commodity relationship that's completely broken down. As such, I'll tell you right now, I took a short position. I took a defined risk short position specifically in oil today. Why? Well, strength in the dollar. Oil has effectively been up. By the way, if you want to look at this on a year-to-date percentage, oil just the other day was up about 6% on a year-to-date basis and is now up almost 20%. This is not contract adjusted. Nevertheless, you kind of get what I'm saying. This is an explosive move. Feels like a short squeeze to me. For those of you that do read a little bit into oil, if you read into oil, okay, you'll realize the oil futures themselves actually flipped. 23 days actually exceeding, of course, the September, which is exceeding OCC. All right, so we've completely flipped over on the oil. Volatility as well in oil is fairly chaotic. So again, nice to see a little bit of an inversion in terms of the oil futures. Okay, now things are going to get really interesting. You got to tune into the financials, the XLF, and I'm going to open this up on a much more substantial chart. So let me kind of clear up the chart. This happens to be the last 9 months. I'm going to close up that left side bar. And what you're looking at over the last 9 months, let me be really, really specific in terms of the levels. Once again, this happens to be none other than the financials. Okay, so it's the financials. And the financials have come down and they've really tested right and around this range. Now this, when I'm circling right here, that is in the depths of ugliness. I mean, look at the volume out there. That is in the depths of ugliness in early February when the marketplace was just, exploding in volatility. And we came down and we touched right around this 2650. And then we came down right here in another bout of extreme volatility in early April, and we touched 2650. And we did it again in another bout of big volatility at the end of April, and we came close yet again in May, kind of June timeframe. Today, it's the first time we've actually cracked through it. And you're like, who cares? Okay, you have to realize right now what this is saying about the financials. The financials are in more trouble right now than they have been at any other point in this entire year. They're at the yearly lows. Why should I care? This is why you should care. Take a look at like a 3-year. Okay, in fact, to make this even a little bit more apparent, I'm going to go into a 3-year weekly. And if you start to look at the 3-year weekly, you see how dire this happens to become. People, there's nothing below here but a whole lot of air. And again, I am not a big market technician. Nevertheless, this level, again, of this 2650 is absolutely critical. And you got to watch the financials. Why? The financials break, we all go. And when I say we all go, I'm specifically referencing the S&P futures. The financials unto themselves, okay, are more capable of pulling down the S&P futures than our technology stocks. And you need to be very, very mindful of that. Listen, we already have a leg kicked out from us in terms of the Dow. And I haven't talked about the Dow that much because, quite frankly, 30 stocks, who cares? But we have some heavy market cap stocks inside of the Dow, and we've already got kind of a leg kicked out of us in the Dow. You lose the financials, the S&Ps are going to come down hard and fast. Now, I don't want to focus that much on tech other than some of the wild volatility. I mean, really, what's to say about Amazon other than, if you look at Amazon this morning, this thing traded, again, 1710, sold off all the way $50 from high to low. Now, hey, listen, I'm not one to talk much about, again, individual stocks, but I will tell you this. You want some volatility? You got some volatility. I mean, for those of us that trade on an intraday basis, one of the things I told you in this weekend's video, I said, you got to watch Amazon because Amazon right now is holding together XLY. Look what's happened to XLY just since we talked about it. Again, this weekend, we're hitting some of the depths of it. Again, unprecedented volatility. However, the volume isn't necessarily there, which means we're absolutely nowhere near capitulation. You also have to start to take a look at XLK because in terms of the spider, the technology, we'll get that one right one of these days. In terms of technology, you're in trouble in a big way. Also, one of the individual underlyings that I look at as a litmus test for the entire marketplace happens to be none other than Intel. I mean, Intel, you're riding with a $230 billion market cap, and it's under some big pressure right now. All right, let's spin back around and talk about the S&P futures because anytime we start to hit patches of volatility, and we're definitively in a patch of volatility. Okay, anytime we start to hit patches of volatility, what we want to focus on, more than just direction. What's more important than direction? I'll tell you exactly what's more important than direction. All right, we're actually going to back out. We're going to look at 90 days, and we're going to go to 2-hour time frame. Okay, over the last 90 days. So anytime we hit bouts of volatility, all we do is just bounce from level to level. And it's the levels that are important right now. And this is what you want to be mindful of. And again, whether you're bullish or bearish, put it aside, shelve it for a second. Okay. I know everybody right now is like, woo, we closed at 2,700. Listen, 2,700, we may dance around it. We did that for quite some time back in like late May, and broke below it. But what we're really looking at is these gravity points. And again, let's highlight the gravity points. This happens to be 2731 right down here. 2682, and you should use price channels and put them down, on your system. Over here we have 2626. All the way down below happens to be 2575. Now what we anticipate is that we're actually going to start dropping back into these levels, and literally, to see some sell side activity right now. If we're going to see some sell side activity, we'll likely come right down to the 2682. From 2682, if we're going to bounce right back up. Back up happens to be 2731. Listen, that's a huge range in there. That's an absolute huge range in there. What do you think we've been doing, though, month in and month out? I mean, I can show you time and again. Earlier this year, we actually took off. And again, we're only back right now, just so everybody's clear. We're only back at the time frame of March. But I can show you time and again us just pinging back and forth between levels. In fact, we're about to do just that. Let's go take a look once again, very specifically at some of these levels. So I'm going to expand out a little bit of the time frame right now. So in the time frame, I'm going to knock this thing out, and we're going to go 4 hours. We're even going to punch it out to 180 days because I want to show you how very important these levels are. And what I said, we're just going to ping back and forth between specific levels. And please, these levels, okay, they took a tremendous amount of time to be able to actually pull out of the marketplace. And again, we're what we call gravity points. We've explained them in huge detail here at TheoTrade. But pinging back and forth between these levels, okay, is what we do in the midst of volatility. But one of the important things you want to be mindful of, and I'll give you an example. If tomorrow we come down to this 2682 and we actually were to cross right through the 2682, you have to recognize how dire that happens to be for the market. So the intensity to which we trade to one of these levels, by the way, here's actually a test into 2682. You can see up here we actually stopped at 2682, bounced, okay, then came right back up to the 2731. And again, we're just going to be pinging back and forth between levels. But the intensity of the trade crossing through a level could be everything. It'll actually give you an idea of how serious some of the sell side activity happens to be. Now, I have been and will maintain a very bearish stance, okay, in the near future. For the first time, the marketplace, okay, if you're a dip buyer out there, and I talked about this on Monday, you're going to be feeling the fear, right? This is where everybody's like, well, I should come in and step in, okay? At this point in time, financials, all right, they've actually cracked. The Dow has absolutely cracked. The Russell, you realize it's in big trouble. What's holding us together right now? Listen, the Nasdaq, this thing is just like, again, scraping its knee. It's just getting started. Okay, if we're going to see some sell-side activity, if things are going to get wild, okay, the biggest downside clearly would have to be inside of the Nasdaq. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening, everybody. Bye-bye.